So we have the current expectations coming in at 60, super solid. Current conditions coming in at 86, really solid. One-year inflation, almost 5%, really high. I don't get these numbers.
I think consumers aren't really sure what's going on either. On one hand, they feel pretty strong about their incomes and they feel strong about the labor markets. On the other hand, they are still feeling the pain of high prices. Inflation expectations, that one-year mark, has been bouncing back and forth for the last 4 months. And uncertainty over short-run inflation expectations continues to be very high. So I do expect this volatility in short-run inflation expectations to continue in the months ahead.
Were there any evidence, Joanne, and great to speak with you today, that some of the SVB fallout had any impact on consumers, concerns about getting a loan, those sorts of things? Did that play out at all in the sentiment figures?
Not really. So we now have about a month of data following the collapse of SVB, and there hasn't really been much of an effect on sentiment at all. In a very small subset of the economy, the very highly educated and high-income families are feeling a bit worse because of the financial turmoil, but on net, very little impact on sentiment at all.
Joanne, interestingly enough, we also had gasoline prices start to recently move up. The IEA was talking about how that's going to be a siege on consumers. Are you seeing that reflected yet in the data? And how do you expect that to kind of filter through?
That's a great question. So yes, we are seeing that in the data already, actually. Consumers are increasingly mentioning gas prices and increasingly mentioning concerns over gas prices, which we hadn't seen in a few months after kind of the easing of prices that we saw last fall. And so that is one of the reasons why inflation expectations are going up. We see concerns over gas prices and continued hurt from high prices overall.
What do you make of the fact then consumers are still buying? Retail sales, the headline number maybe was weaker, but the unadjusted one, is still a resilient consumer. Why are these figures strong, again, despite the fact that they're concerned that more is going to be taken out of their pocket in the form of inflation?
What's supporting strong consumer spending continues to be a strong labor market. Consumers feel pretty solid about their incomes. They feel pretty solid about the prospects for employment in the year ahead. And that's what's supporting strong levels of spending. That being said, consumers are starting to show a bit of concern over rising unemployment rates in the year ahead, though this is primarily limited to those with higher educations. But those tend to be the higher income folks who generate more spending. So there could be some bumpiness ahead.
Joanne, why do you think that the funding issues and the SVB stuff hasn't really filtered through on this level? Because we always keep hearing that, look, you're going to have the funding stress, it's going to feed into lending, it's going to feed into small businesses, it's going to feed into everyday people. Why do you think we're just not seeing that?
I think part of the reason is that this tightening of credit that we're kind of looking for in markets is something that takes some time to pass through to consumers. There is a lag, just like there's a policy lag with tightening interest rates. And historically speaking, the consumer reaction is very similar to what we've seen in the past with past banking failures. Consumers don't really respond to specific episodes of a specific banks collapsing. We didn't see it with SNL, and we didn't see it prior to the Great Recession. However, if it results in material tightening of mortgage lending and other forms of consumer credit, that's when we'll see effects on consumer sentiment.
But Joanne, there was the NY Fed survey that said, in terms of the share of households who see it harder to obtain credit versus a year ago, that did tick up in March. And I think this is part of the difficulty that I've seen is that survey data, soft data, hard data, all of it has just been really volatile at this moment. How do you think about wrapping your head when it sometimes feels that data points are contradictory?
I think consumers are just as confused as experts at this point. When they see mixed data, they don't know how to respond to either. And yes, we are seeing signs of credit tightening even in our data as well, though that's primarily due to higher interest rates and wasn't differentially so just in the last 30 days from the consumer's perspective, though of course from a lender's perspective it might be different.
Joanne, just to wrap in the bank earnings that we've seen, from a macro perspective, Citi talking about a likely recession in the back half of the year. They're talking about the tightening credit standards. Sanders and consumer lending that you were just talking about. We've seen charge-offs continue in the credit card businesses. JP Morgan's Jamie Dimon still talking about those storm clouds that are coming. Where in the data should we expect that kind of macro environment to start showing up if what the CEOs are saying is true?
So consumers have actually been anticipating a recession since last summer. They've been waiting for the other shoe to drop for quite some time. So consumers are expecting a downturn. They're not feeling as dismal as they were last summer, but it's still overall, they're waiting for the other shoe to drop at this point.
So Joanne, if the answer to our question of the day is delayed, what does the delay look like? What does history tell us when these sorts of events, when things breaking, when banking issues finally start to hit consumers?
They're going to start hitting consumers, I think, in this context when we start seeing material deterioration in labor markets. The reason why consumers are still continuing to spend despite they're waiting for the other shoe to drop is because they have strong incomes to support their spending. Once unemployment starts to tick up, that's when consumers are really going to start to pull back.